there. So now we are discussing about the adjustment number. So adjustment number 1 was done completely. Adjustment number 2 actually has one more adjustment which I was about to do when I was about to explain you about the finance cost. But fine, I will just discuss this here. Okay, we will understand. See, we calculated this. Let me do the working notes. Let me just give you the working notes details. So I have I have done the calculation, right? In working notes, I explained you how we got this liability of 1.012 into 0.9091. We got 0.920. This was something company has to pay to the employee. Yes. So that happened to be 920K. Yes or no? Mansa, you remember? Yeah. So
Yes, sir.
920 is what we have to make the provisions. We made a provision of 800. So 120 still to be provided. So we took this 120 here in the operating expenses. But if we see this whole adjustment, 1st January, we start our year from June 1st, July 1st, sorry, in this question. We end the year at June 30. So this January comes in between July 1st and June 30. So on January 1st, Duggan company was notified that employee had started court proceedings against them for unfair dismissal. And they got a assurance, they got a clarity from their legal team that it is 80% that they will lose this and they have to make the payments. Fine. So we calculated the present value of that liability or obligation, as we show this as provision, right? So we calculated the present value of this liability. Yes or no? Now, see what you have to check here. When will they make the payment? Would need to pay an estimated this much on 1st January 2009. January 1st, 2008, we calculated the liability, it is 920. We showed 800. We have to recognize 120. We understood extra. That means we need to show 920, right? We already shown this much. We need to show this extra and we have recorded this. But this January, we are closing the year. So this 920 has to become how much? 1012 at the end of 1 year from Jan 1st, 2008, Jan 1st, 2009. 920 will become 1012. This 920 will become 1012 with what? With adage of interest. Yes or no? Yes.
Yes, sir.
Now, this is whole 1 year interest, which will make 920, 1012. You know how we got this 920. Present value of 1012 is 920. So this will become 1012. But you see, we are closing the books on June 30th, 2008. We are closing the books. So we can't take whole 1 year's interest, right? We have to take the 6 months interest also. Yes or no, Mansa? In 6 months, the liability will become 920 plus the 6 months interest. We call it as unwinding of discount.
Yes, sir.
Very important point. Unwinding of discount is nothing but interest costs, extra interest cost. So we will calculate it. How we will calculate it? So we will do the calculation right now. We will take the amount. So what is your liability? So the interest. So we'll take the liability amount. Liability amount happens to be Just a second. I'll do the calculation and write the amount. 10% into 6 by 12. Okay. Into 6 by 12. Okay. So my liability is 920 on this 6 months interest. Okay. So 1012 minus 920 is 92. That is whole year's interest. So 920 into 10% into 6 by 12. What will that amount be? So 920 into 10% is 92. 92 into 6 by 12 is 46. This,
46.
yeah, this is the interest cost or unwinding of discount we will show in finance cost. So simultaneously, I'm writing the finance cost also. What is the finance cost? $1240. Plus unwinding of discount. So unwinding of discount also we added up. Okay. Now next point. So this is unwinding of discount calculation done. We are going to show this in our finance cost. So taken here, shown here. This is done. Let's move to the next part. So adjustment 1 completely done. Adjustment 2 also completely done. Whole adjustment 2 is done. We have shown 120 in the operating and we have shown 46 in the finance cost. Okay. Now we are going to the adjustment 3, which is about taxation. We will do that also right now. Taxation. Already explained in the morning that whenever you have tax amount in the credit side, it is over provision, and in the debit side, it is under provision. So we'll take the over provision. And what is the current year estimate of tax? The current year estimate we need to see. So current year, the tax estimate is 2.1 million. So, okay, we will take that. Now, you know, over provision we have made. So we need to adjust this year. That means this year, this will reduce my tax expense. Why? Because I already have estimated more in the previous year. So this year I need to use that balance and adjust. Okay. Yes or no? So in this year, if I have made some estimate and see previous year, if I made less estimate, I need to add. Okay. And that I need to carry forward. If I made overestimate, I need to adjust. I need to reduce that with this year's estimate. Okay. I will make more estimate this year or less estimate. If I've already made more, what will I do? I'll make less estimate. Yes or no? See, my estimate is already made. My estimate is how much? 2100. But previous year, I made a over provision. So this year, I need to adjust now. That will reduce my current year's estimated tax expense. Less over provision of tax. How much that is? 130. Now, in addition to this, there has been a decrease in taxable temporary difference. See how taxable temporary difference gets created. Everything starts from the different treatments what we give in the accounting books and the tax returns. Let's say we are the tax base of an asset, we are taking 1 lakh. See, carrying amount is 1 lakh and tax base of the asset is 80,000. Or else let's say take 1 lakh. Here the depreciation is 30,000. Here the depreciation is 20,000. Okay, so here book value is 70, here it is 80. What will happen? Accounting income before depreciation 50,000. Tax returns before depreciation, let's say 50. Now depreciation 20 is accounting income, 30 is tax returns. 10% if I have to pay tax, I'll pay 2,000. Here I have to pay 3,000. Okay, this is I'm paying more. But imagine if I reverse the case, my case is taxable temporary differences have reduced. Okay, so 10,000, 1 lakh. If I take depreciation 20, 30, 70K, sorry, 80K, 70K. So accounting income after depreciation from 50, if I take 20 depreciation, I get 30K, and tax returns 50K minus 30K, I get 20K. So now if I made a provision of 3,000, I have to, but I'm paying a tax of 2,000. This 1,000 difference is getting created because of what, Mansa? It is getting created because here the depreciation is more and here the depreciation is less. Yes or no?
Yes.
So the difference is how much? 10,000. This 10,000 into 10%.
10,000.
10,000 is taxable temporary difference. Yes or no? Taxable temporary difference is 10,000. This is the difference got created because of different depreciation amounts. Here the depreciation is more, here the depreciation is less. So 10% is how much, Mansa? 1,000. This 1,000 I need to pay in the future.
1,000.
Yeah, I need to pay in the future. So this 1,000 is creating what for me? DTL. Yes or no? Now imagine my taxable temporary difference. I need to pay how much taxes in the future? 1,000. Let's say my taxable temporary difference is 10,000 and tax rate is 10%. I need to pay 1,000 tax in the future. Instead of this 10,000, my taxable temporary difference have become 5,000. Yes or no? Now 10% is how much, Mansa? 500. My tax expense is now 500. Previously it was 1,000. It has got reduced or it has increased?
Reduced, sir.
So if my taxable temporary difference gets reduced, it creates it what it does, it reduces future tax expense. Now I can say deferred tax credit. I don't want to use such terms. I can very simply tell my tax liability or my future taxes I need to pay was 1,000. Now I need to pay 500. My tax liability or my tax payment has reduced by 500. It is reducing my tax expense. Yes or no? So taxable temporary difference, when it reduces, my taxable temporary difference has reduced from 10,000 to 5,000. So 5,000 less has done wonders. So that 5,000 less is making me to pay tax less by 500. So now my tax expense has reduced by 500. This I need to adjust in the current year tax expense or not? I need to adjust. So I will do that. So in our example, in our question, what they have given is, Mansa understood this adjustment? Any doubts?
Sir, understood, sir. No doubt.
So taxable temporary difference, if it reduced or it reduces, it decreases your tax expense. So your tax expense reduced, so you need to adjust this year. We are going to adjust that right now. So in addition to this, there has been a decrease in taxable temporary difference of 2 million in the year. Duggan company pays tax at the rate of 25%. So 2 million is 20 lakhs into 25%. This is your taxable. There has been a decrease in taxable temporary difference of 2 million. So this is taxable temporary difference reduced. So this will create what? This will reduce my future tax expenses. My tax liability will reduce. My tax payment will reduce. In the future, I will pay less tax. So what they are saying now, they are specially saying movements in the deferred tax are to be taken to the statement of profit or loss. So this movement also we will take here and adjust. So what is the amount here? 25 to the 500. So 5 lakhs. So 500 is the amount I need to adjust. I will adjust here. So I will write this working notes. I must write. So here there are two things: temporary taxable difference and deductible difference. There are two things. One creates a deferred tax liability, one creates a deferred tax asset. So here we are doing an adjustment related to deferred tax liability. So we will reduce that also, minus 500. Reduction in taxable temporary difference. So we got, adjusted. What is the amount here? 100 minus 15. 2100.
1470.
Yeah, 1470. Yes. So we will adjust this here. So income tax expense 2100. Okay. So this adjustment also completely done. So 3 adjustments are totally done. No need to look at them. Now Duggan company issued 5 million 6% convertible loan notes. Now I have to tell you something. See, convertible loan notes are compound instruments. What happens in case of compound instruments? There are two elements. One is liability or debt, and one is equity element. So you need to understand there are two elements in this. Okay, once we calculate the debt element, the leftover is equity element, and you have already studied this in your financial instruments. So financial instrument adjustment also covered here. What are they saying? They're saying they issued 5 million loan notes. So 5 million is the borrowing company has made. They have to pay 6% interest. This is the coupon rate. So 5 million into 6% will be 50 lakhs, 6%, I think 3 lakhs. Yeah. So 3 zeros omitted. So we need to pay 300 interest in the first year. For any borrowing, we need to make the payments, right? So Duggan company issued 5 million 6% convertible loan notes on July 1st, 2007. So they borrowed on first date. Borrowed on 1st July. Interest is payable annually in arrears. So they make the annual payments. These bonds can be converted into one share for every $2 on 30th June 2009. So later on conversion can be done. So what happens, since the convertible bonds give the conversion option, we will first try to find out the debt element and we'll see how much the bond holders are paying for these kind of bonds. Are they paying some extra money to purchase these bonds? The extra element what they are paying to purchase these bonds will be equity. Yes or no? Because see, it is justified that they can make some premium payment for buying such kind of bonds, which right now can give them stable income for 2 years. And after 2 years, when company is doing well, they get upside income. They get upside because, the equity, the bonds will convert into equity, and the equity prices, if rise in the future, they can enjoy the benefits of price rise, plus they can get dividends, plus they can get profit share. So all these benefits, they have. So of course, this issue, the bond issue, the loan notes issue will definitely attract some premium payments. We will see how much extra these people are paying. Are you understanding, Mansa?
Yes, sir.
Now, similar loan notes without conversion rights. That means if you are taking a loan note of like similar kind of loan note, like what Duggan company is issuing such kind of loan notes, or such kind of company. Let's say Duggan company is into some, it is a EV company, EV manufacturing company, electric vehicle. Similar kind of company issues a bond in the market without any conversion rights. So they are paying, or they are giving a return of 8% to the investors. That means they are paying 8% interest, or you can expect 8% interest in the market for similar kind of bonds. What is relevant for you? Is this relevant for you as a discount factor, or market interest rate is relevant for you as a discount factor? Hello?
Yes, sir.
If you want to find out the present value of those future payments, coupon rate is relevant or market interest rate is relevant?
Market interest rate.
Of course, what every investor is expecting the returns, that is relevant for us. Yes or no? So we will do that only right now. So second year, 300 payment will again be made, because this till 2009, they have the chance to convert 30th June. So these 2 years, interest will be paid, and in the second year, when the conversion will happen, the loan note will get converted into equity. So that means the maturity is for 2 years. We can expect. Yes or no? Yes. So I will write the principal repayment of 5,000 also. So this 300 and this 5,300. So we will discount it. 300 for 1 year, 0.926, 5,000. 300 into 0.850. Just multiply until this and add them. We get the present value.
The 4819.8.
Yeah. Four one eight one 4819.9. I can directly take 4820, right? This is my liability. So for this issue, we got how much? 5,000. So 4,820 is my liability or debt element. So what is the difference? Can I say this is my equity element? Yes or no?
Yes, sir.
That's what. Fine. So we got the equity element also. Now, Duggan company recorded the full amount in liabilities. Fine, 4820. So we are not even making the balance sheet, and has recorded the annual payment made on 30th June 2008 of 0.3 million in the finance cost. Actually, now we need to calculate the finance cost. So 4820 into 8% is my interest. Actually, my liability is this much, right? My interest is, see, what happens, 6% shows the coupon payment, but 8% I multiply with this, the effective rate of interest shows me what is my interest expense. Yes or no, Mansa?
Yes, sir.
This shows interest payment. This shows interest expense. Both have differences. Interest expense will be a combination of, you know, amortization of loan note and the interest payment. See, do you have idea about all that, Mansa? You remember all that amortization of loan note and also interest payment. So interest payment plus amortization. See, what happens is a bond will be either issued at premium or a bond will be either issued at discount. So if the bond is issued at premium, amortization of premium; if it is issued at discount, amortization of discount. So this two will be, so your interest payment plus amortization of discount will be interest expense, because bond has to reach to its face value. Interest payment minus amortization of premium will be interest expense, because already extra money has been paid for the bond, for example, that has to be reduced. So we get these two figures. Are you understanding? But right now, right away, you just don't go for all this. You only understand that this is my liability and this is my effective rate of interest, and I calculate interest expense on effective rate of interest. Yes or no?
Yes,
Hello? Hello?
yes, sir.
Are you following? So I'm,
Yeah, sir, follow.
yeah, so 385.6 you will get. That will be 386. So 386 is the interest expense, but how much have you recorded? How much you need to record? Extra, how much you need to record now?
86.
That's what. This is your finance cost. So just have a look through this, Mansa. I'll move forward fast.
Okay, sir, I've written it down.
Yeah, just a second. So these are, something which you'll be learning for, accounting for liabilities, but I think that is there in your financial instruments, if I'm not wrong. Mansa, is this there right for you? I think this is there. So you should be knowing
Yes, sir, it is
this.
there.
So we just added 86. So we need to add 86 in the finance cost. So I added up. Now what is the next thing left over? We have to check. So the whole adjustment 4 is done. Adjustment 5. Now this is again with respect to capitalization of interest. That means borrowing cost. We are going to discuss about borrowing cost. Duggan Company began the construction of an item of property on 1st July 2007. Okay, they started the construction on July 1st. They completed on 31st March 2008. That means how many months they took for completion, Mansa? 9 months. A cost of 32 million was
9
capitalized.
months.
Yeah, so they have capitalized 32 million, and that 32 million also included 2.56 million being for full 12 months interest. Now you tell me, Mansa, if your construction completed in 9 months, you have to capitalize for 9 months or you have to capitalize for 12 months? Only 9 months. Yes. So you
Only
have,
9 months.
Yeah, your construction completed in 9 months, right? So you can capitalize only for 9 months. So extra capitalization has been done. Is that right?
No, sir.
Yes. So you have to only capitalize for 9 months. So what you need to do, you capitalized for 12 months. Actually, construction completed in 9 months. So capitalization should happen for 9 months, but you capitalize for 12 months. So extra capitalization of how much? 3 months. That 3 months capitalization you need to rectify. That means you need to expense. So now we will calculate that. Okay. 2.56 into 3 by 12. Just calculate and tell me the amount.
So 0.65.
0.65. Also simultaneously calculating. Just a second. We will take 1 second. 2.56. What is the, just a second. We have to see the interest amount also, right? Sorry, did not see that. 2.56 interest. Fine. This is the interest amount already. 25.6 into 10%. Fine. Into, okay, to 0.64. So actually it is 2.56 million. Okay, so we'll take 25 lakh 60,000 into 3 by 12. So we get 6 lakh 40,000. So this much we need to expense, Mansa. That means 1.92 million we need to capitalize for 9 months. 0.64 million we need to expense. Correct? So we are going to expense now. Yes.
Yes, sir.
So we need to, so this was related to capitalization of interest, so interest cost, finance cost. So we'll add 640 to finance cost. We will expense. We expensed, fine. So now one more catch in that is, see what had happened if you capitalized your asset with extra 0.64, your asset has increased more by 0.64. Yes or no? Asset increased more by 0. See, you added extra value to asset. Extra value you added, so it increased your asset value by 0.64 or 6,40,000. Yes or no?
Yes.
So this creates excess depreciation. More value added to asset by mistake, which you shouldn't have done, has created extra depreciation, which you have already recorded, which you need to rectify. You need to correct. So extra depreciation already shown, we need to subtract now. So we will find out that extra depreciation or excess depreciation amount now. So where is that? So what is the, on completion, the property has a useful life of 20 years. This much in the operating expenses representing depreciation on the asset for the period. Okay. 0.6, just a second. 31st March to 30th June. This is for 3 months. Okay, fine. Okay. 6,40,000 divided by 20. How much is this, Mansa? Calculate and tell me.
32,000.
32,000 into 3 upon 12. Because we are closing the books in the month of June, and the completion happen like
8,000, sir.
8,000. Yeah. So this is reduction in the depreciation charge. Mansa, understood? Any doubt in this?
Sir, no doubt, sir. Understood.
Okay, we'll move forward. Such is the question. You see how big this question is. It has been discovered that previous financial controller of Duggan Company engaged in fraudulent financial reporting. Currently, 2.5 million of trade receivable has been deemed to not exist. That means those customers are not at all there, and they have to be written off. So of this much relates to this year ended. So we will just show this is related to earlier periods. We don't want earlier periods. We want current period. So how much we need to write off? 0.9 million. 0.9 million is 9 lakhs. 3 zeros omitted, 900. So we need to show that. Mansa, tell me the totals. Finance cost.
Sir, 2012.
Yeah. And investment income given in the question is
20.
120. So if you adjust everything, what's the profit for the year? Net profit. Finished. That means I took the tax also, everything I did. Okay. Just calculate and tell me.
Yes, sir. 4806.
Yeah. Till here, you get PBT.
Yes,
That
sir.
is 6276 minus tax, PAT. Finished.